Right now, the IRS is sitting on something that could change everything for millions of senior homeowners in America, and nobody is talking about it. April 15th, 2026 is 11 days away. And after that date, your home could be at risk. And I am not exaggerating. If you are 65 or older and you own a home in the United States, you need to stop everything and listen to this because what I am about to tell you is backed by IRS documents, federal law, and real enforcement data that most people have never seen. And before we go further, let me be very clear about something because there are a lot of clickbait videos floating around right now saying the IRS is going to come and take your house on April 16th. That is not exactly how it works. The IRS does not knock on your door on April 16th and hand you an eviction notice. But what does happen after April 15 is a chain reaction of penalties, interest, liens, and enforcement actions that can absolutely lead to you losing your home. And that chain reaction starts the moment you miss the filing deadline or make one of several critical mistakes that seniors make every single year. So let me walk you through the real facts step by step. First, let us talk about what April 15th actually means for seniors in 2026. April 15th, 2026 is the federal income tax filing deadline for tax year 2025. And this year is unlike any year before it because of a brand new law called the One Big Beautiful Bill Act, which was signed into law on July 4th, 2025. This law introduced massive changes that directly affect seniors and homeowners. And if you do not know about these changes, you could be leaving thousands of dollars on the table, or worse, you could be triggering penalties without even knowing it. Here's the first forensic fact. Under the One Big Beautiful Bill Act, there is a brand new deduction called the Senior Bonus Deduction, and it gives every American aged 65 and older an additional $6,000 deduction on their federal taxes. If you are married and both of you are 65 or older, that is $12,000. This deduction is available for tax years 2025 through 2028, and it is in addition to the regular standard deduction, which for 2025 is $15,950 for single filers and $31,500 for joint filers. But here is what most people do not know. This deduction has an income phase out, and it starts at $75,000 for single filers and $150,000 for married couples. So, if your modified adjusted gross income is above those thresholds, your $6,000 bonus starts shrinking and eventually disappears. Why does this matter for your home? Because if you sold your home in 2025, or if you are planning to sell it this year, and you do not properly account for the capital gains from that sale, it could push your income above that phase out threshold, and you lose the deduction entirely. And that is just the beginning. Let me give you the second forensic fact about capital gains and home sales because this is where most seniors get blindsided. Under IRS Section 121, you can exclude up to $250,000 in capital gains from the sale of your primary residence if you are single and up to $500,000 if you are married filing jointly. But here is the catch that nobody tells you. You have to meet what the IRS calls the ownership and use test, which means you must have owned and lived in the home as your primary residence for at least 2 out of the last 5 years before the sale. Now think about this. According to the National Association of Realtors, the median home price in America crossed $420,000 in 2025. A senior who bought their home in 1990 for $100,000 and sells it in 2025 or 2026 for $850,000 is sitting on a $750,000 gain. If you are single, you can only exclude $250,000 of that gain, which means $500,000 is taxable. At the 15% long-term capital gains rate, that is $75,000 in federal taxes alone. But it gets worse because that $500,000 taxable gain does not just hit your income tax. It also counts toward your modified adjusted gross income, which means it can trigger something called IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is a surcharge that Medicare adds to your Part B and Part D premiums when your income goes above certain thresholds. In 2026, the IRMAA threshold is $19,000 for single filers and $218,000 for married couples filing jointly. A Fortune magazine investigation published on March 11, 2026, found that most retirees who sell their homes have no idea that the profit from the sale can spike their Medicare premiums by thousands of dollars a year. And they do not find out until it is too late. According to Kiplinger, the highest IRMAA bracket for Part B in 2026 can add several hundred per month to your premiums. And Part D search charges can reach up to $91 extra per month on top of that. So, selling your home without a plan does not just create a tax bill, it can raise your health or costs for years. Now, let me explain the third forensic fact, which is about IRS tax liens and how they can lead to losing your home. When you owe the IRS money and you do not pay, they do not just send you an angry letter. They follow a very specific legal process. First, you get a notice and demand for payment. If you do not pay within 10 days of that notice, a secret statutory lien automatically attaches to everything you own under Internal Revenue Code Section 6321. That means your house, your car, your bank accounts, everything. For debts over $10,000, the IRS typically files a public notice of federal tax lien at your local county courthouse. Once that lien is on public record, it shows up in title searches, which means you cannot sell your home, you cannot refinance your home, and your credit is effectively frozen. And if you continue to ignore the IRS, they can escalate from a lien to a levy. A lien is a legal claim against your property. A levy is the actual seizure of your property. Of the IRS has the legal authority to seize and sell your home to satisfy a tax debt. Now, in practice, the IRS rarely seizes homes because there are many steps before that happens, and there are protections in place. But here is what people miss. It is not just the IRS that can take your home. According to a 2025 totality report, property tax delinquency rates in America hit 5.1% nationally, and that number is climbing. A Facebook community tracking Ohio foreclosures reported that in 2025 alone, total foreclosure filings, including tax liens, reached approximately 9,236, driven by a 30 to 37% increase in property taxes. And Adam data reported that U.S. foreclosure filings jumped 32% year over year in January 2026, with over 40,000 properties receiving default notices in a single month. Seniors on fixed incomes are the most vulnerable to this because when property taxes go up and income stays flat, something has to break. The SALT deduction, which allows you to deduct state and local taxes, was raised from $10,000 to $40,000 under the One Big Beautiful Bill for 2025, and it goes up to $4,400 for 2026. But here is the problem. Most seniors take the standard deduction. According to the Tax Policy Center, about 90% of taxpayers take the standard deduction instead of itemizing. And when you factor in the new Senior Bonus Deduction of $6,000 per person, the standard deduction floor for a married couple, both over 65, is now $44,200 for 2026. That means your itemized deductions, including property taxes, mortgage interest, and charitable donations, have to exceed $44,200 before itemizing makes sense. For most seniors, it does not. So even though the SALT cap went up, most seniors will never benefit from it. And meanwhile, their property taxes keep rising, and the risk of falling behind keeps growing. Now, let me give you the fourth forensic fact, which is about IRS enforcement and how it has changed in 2026. The IRS workforce was cut by approximately 27% in 2025, going from about 102,000 employees down to about 74,000, according to the National Taxpayer Advocate's 2025 annual report to Congress. You might think fewer IRS employees means less enforcement, but it is the opposite. The IRS is now relying heavily on automated data matching systems and artificial intelligence to catch discrepancies. According to a March 2026 Open PR report, the IRS is using advanced analytics to compare what you report on your tax return against data reported by banks, employers, payment processors, and real estate closing agents. The IRS automatically receives Form 1099s whenever you sell a property, and they receive Form 1099-R when you take retirement distributions. If the numbers on your return do not match the numbers the IRS already has from third parties, you will get flagged. And here is where it gets dangerous for seniors specifically. According to Kiplinger, which published 11 IRS audit red flags for retirees in January 2026, the most common triggers include unreported capital gains from home sales, missed required minimum distributions, overvalued charitable donations, and incorrect reporting of Social Security income. A Yahoo Finance article published just 3 days ago identified 4 specific tax mistakes that seniors make that can trigger an IRS audit. The first mistake is failing to report all income sources because seniors often have multiple 1099 forms from pensions, Social Security, investments, and part time work. The second mistake is assuming Social Security is not taxable, when in fact, up to 85% of your Social Security benefits can be taxed depending on your other income. The third mistake is claiming large charitable deductions without proper documentation, especially for donations over $250, where the IRS requires a written acknowledgement from the charity. And the fourth mistake is missing required minimum distributions, because once you turn 73, you must withdraw a minimum amount from your 401k or IRA every year. And if you do not, you face a penalty of 25% of the amount you should have withdrawn. Any of these mistakes can create a tax bill you did not expect, and that unexpected bill can start the lien process I described earlier. Now, here is the fifth forensic fact, and this one is about scams. Because while the IRS can create real problems, there is an entire industry of criminals pretending to be the IRS and specifically targeting seniors. The IRS published its Dirty Dozen list of tax scams for 2026, and phone scams are at the top. The Federal Trade Commission issued a warning in January 2026 about calls from a fake agency calling itself the Tax Mediation and Resolution Agency. These scammers use spoofed caller ID to make it look like the call is coming from a real government number, and they demand immediate payment by gift card, wire transfer, or cryptocurrency. The IRS has been very clear about this. The IRS will never call you demanding immediate payment. The IRS will never threaten to arrest you over the phone. The IRS will never ask for gift cards or cryptocurrency. If you get a call like this, hang up immediately. But here is why this matters for your home. Some of these scam operations have convinced seniors to take out home equity loans or reverse mortgages to pay fake tax bills. Once that money is gone, it is gone. And now you have a real debt against your home that you did not need. So, the threat to your home is not just from the IRS itself, it is also from criminals exploiting your fear of the IRS. Now, let me bring this all together and tell you exactly what you need to do before April 15th. Number one, file your tax return even if you cannot pay. The failure to file penalty is 5% of your unpaid taxes per month up to 25%. The failure to pay penalty is only 0.5% per month. So filing without paying is 10 times cheaper than not filing at all. Number two, claim the Senior Bonus Deduction. If you are 65 or older and your modified adjusted gross income is under $75,000 single or $150,000 married, you are eligible for an additional $6,000 deduction per person. This is brand new under the One Big Beautiful Bill, and millions of seniors will miss it. Number three, if you sold your home in 2025, make sure you properly calculate your capital gains exclusion under Section 121. Track every capital improvement you made to the home because each improvement increases your cost basis and lowers your taxable gain. New roof, new kitchen, added bathroom, replaced HVAC system. All of these count. Number four, check your Medicare IRMAA exposure. If the profit from your home sale pushed your modified adjusted gross income above $109,000 single or $218,000 married, you will pay higher Medicare premiums. And that surcharge is based on your tax return from 2 years prior. If you had a life-changing event like a retirement or the death of a spouse, you can file an appeal using Medicare Form SSA-44. Number five, do not ignore IRS notices. If you get a letter from the IRS, open it immediately and respond within the time frame specified. You have the right to request a collection due process hearing within 30 days. You have the right to set up an installment agreement. You have the right to request currently not collectible status if you genuinely cannot pay. And you have the right to submit an offer and compromise to settle for less than you owe. Number six, protect yourself from scams. The IRS contacts you by mail first, not by phone. Never give personal information or payment to someone who calls you claiming to be from the IRS. And number seven, if your situation is complicated, get help. The IRS offers free tax preparation through the VA and TCE programs for seniors and low-income taxpayers. ARP Tax Aid has thousands of free locations across the country. You can find one near you by calling 8I-2769 or visiting aarp.org/tax. And if you owe money and cannot pay, A tax professional or enrolled agent can negotiate with the IRS on your behalf. Now, let me leave you with the real picture. The headline that seniors could lose their homes after April 15th is not fiction, but it is not a guaranteed outcome either. What is real is that missing the April 15th deadline starts a clock. Penalties start accruing immediately. Interest compounds daily. After multiple notices, the IRS can file a lien against your home, and if you do nothing for long enough, they can escalate to a levy. At the same time, rising property taxes, surprise capital gains from home sales, Medicare surcharges, missed RMD penalties, and scam artists are all working against seniors simultaneously. The system is not designed to be easy to navigate, and the people who get hurt the most are the ones who do not know the rules. Foreclosure filings in the United States jumped 32% in January 2026. The IRS workforce was cut by 27%, but automated enforcement is expanding. Audits on high-income individuals are expected to rise from 11% to 16.5% by the end of this year. And a brand new $6,000 deduction exists that millions of eligible seniors will never claim simply because they did not know about it. That is why I made this video, not to scare you, but to make sure you have every piece of information you need to protect your home, protect your money, and protect your family. April 15th is 11 days away. File your taxes. Claim every deduction you are entitled to. Do not ignore letters from the IRS. Do not fall for scam calls. And if you need help, ask for it because the help is free and it is available right now. If this video helped you understand something you did not know before, hit the subscribe button and share it with a senior in your life who needs to hear this because the information in this video could save someone's home. I will see you in the next